Hello everyone. Now we are going to discuss the lesson 2 of the technical analysis. We have now is moving average. So how to use moving averages. So here, this is my part. This is part of my seminars. No? So this is Stock Strat series. By the way, please do like my Facebook page. You can follow me on Instagram, my LinkedIn, and especially this one. You can watch this one on YouTube. So what is moving average? It is defined by this. A MA or a moving average is a technical indicator for determining if an asset price will continue or reverse a bull or bear market. A SMA or simple moving average can be enhanced as an potential moving average or what we call the EMA that more heavily weights on the recent price action. In layman's term later, in a while for the chart, it is about if the moving, this is the things that this is that main thing that you need to learn. If a moving average, if the price is above the moving average, that is uptrend or that is bullish. If a price is below moving average, that is bearish or downtrend. We can classify them into three categories. Usually, we classify them, or the professionals classify them into three parts, which is the 50, 100-day, and 200-day moving average. So let's start with the example. So by the way, here, the EMA and SMA, so it's just the difference of these two. EMA is more of a tight, later you can see the more dotted one, tight to the price, while SMA is quite far from the price. So let me move this up here. So I have here the macro Asia as an example, MAC. For this one, you can see below. Let me point out the pointer. Sorry, pointer for this slide. Here for the pen. As you can see here for the MAC or MAC, it's above the three moving averages. So what are the three moving averages? It's here. The 50, which is the red one, the 100, the orange, and the 200, which is the green one. I classify it like a, sorry for that, like a stoplight. So red is the first signal, first indicator, orange is the second indicator, then green is the second indicator. So 50, 100, and 200-day moving average. So this is a simple moving average. As you can see here, it's just MA. So here you can clearly see that the price is above the three moving averages. So what is the tendency? The price is just moving up. Now here, there are some time that the stock is sipping or passing through the 50 or 100-day moving average. So that will be your indicator, or that can now be your plan if you are going to sell at the 50. But most of the stock, especially the high market cap, the 50 moving average is not that applicable. Mostly it's the 100 and the 200-day moving average. Later we'll discuss that one. So you can see here, for the 50 moving average, it crosses here or it crossed there. And for the 200-day, it crossed around here. Now let's see. If you buy it around at this one, 4 pesos, and you already sold it or sell it at this point where you can see the price touch the 50-day moving average. So let's assume it's around 17 to 16. So you have probably gained 400% because 4 to 16, that's quadruple of the value. Next, if you pull it out at around 50-day moving average, maybe it's around 19. All right, same with the 100-day moving average area right here. So let's assume it's around 20. So you have 5 times more of your money if you start investing below when it is all above the 50-day, 100-day, and 200-day moving average. So here, there's as you can see, the difference of the two, the EMA and the SMA or the MA. For this one, the dotted one is the EMA. It's really too tight. All right. And let me check that one. There you go. So it's quite the more tighter than the other one. As you can see here, the dotted one more tight. This one is somehow less to react. This is close to the reaction of the stock. Then so as the 200-day moving average. Here on a downward trend, let's check this one. A downward trend, of course, you can see you cannot buy anything around here because the price is below the three moving averages. But for this one, this can now be your indicator. First of all, this is a gap up and it crosses above the 200-day moving average. It crosses above the three moving averages. So yes, maybe it consolidate at some point here, but that's a different topic already. Now we are going to focus. We are only focusing on the moving average. So next, lastly, we have the ICT or the International Container Terminal Services Inc. When the time that it crosses the three moving average around this point, maybe you're going to buy here when it break out from the resistance line at this point. If you buy there, let's assume that you bought it at around 100 pesos. At 100 pesos, if you sell it here, okay, you sold it prematurely, because that is the common problem in stocks. No, it's not always or all the time it's following the rule. Meaning, for this one, it's not all the time that if the stock already cross or break up the support or resistance line, it will not always continue all of the time. Sometimes it's just testing the said line, like for this one. Well, let's say for instance, you sold it at this price, so you gained at around 20%. Let's assume that to have a value which is more clearer value, 20%. Now, if you sold it here at around maybe around 130, right here, 132. So because the indicator of 200-day moving average tells you so to sell it already. Also here, if you sell it at around 200-day moving average, you probably have a 100 or 25% from your 200. Again, these are just indicators, meaning you can by simply looking at this one, if you have a drawing up here, a resistance line and a support line right here, the time that it broke out from this point, most probably that's the time that you are going to sell. Let's have other examples. Here's a actual example of Jollibee. This is a the recent chart. So for the Jollibee, hold on, let me. I'm using a weekly chart right here, and let's see if we will use. Let's use 200-day moving average for this one. For this one, 200-day moving average, then boom, you get 200%. That's how many years? 2010 to around 2016. So that's around 5 years. So you tripled your money in Jollibee in investing for 7 years, 6 to 7 years. So that's the main purpose of that one. Okay. Next, we have last example I have here, JGS. For the JG Summit, same trend for the Jollibee. Then for this one, say for instance, you buy it here when it crosses all the moving averages, maybe somewhere here, because you believe that it will cross it. Then sell it again at 200 here. So you've gained around um, 155%. So that's one and a half, almost double and a half of your money. So there you have it. So this is the lesson two. So this is a moving average. I usually use this one for trends, especially if the stock is on an uptrend. So that's where I focus on. Like for this one or what's happening today, the moving averages are above the price, so it's on a downtrend. So if you have if you have some questions about moving average, please feel free to contact me or send me a message. And please stay tuned for the succeeding or the next tax strat series, as I'm going to discuss some technical indicators more, or technical analysis, and some fundamental analysis. So thank you for watching, and again, please do like and share this to your friends who wants to learn more about the stock market. So thank you for watching.